are for the next session, Growing Old with Peace of Mind, Sustainable Retirement Solutions. We're turning to a different but an equally important question to what we discussed this morning. How can we ensure that people can grow old with financial security and peace of mind? Across the world, pension systems remain a cornerstone of retirement income, but they're under growing pressure. Aging populations mean fewer workers supporting more retirees, labor markets are changing, and traditional pay-as-you-go models are becoming harder to sustain. As a result, many countries are shifting towards multi-pillar systems where insurance-based solutions complement public pensions, which raises questions for today. How can we improve retirement outcomes in practice? How can insurers contribute more effectively? And which policy and regulatory frameworks best support that? This session will look at real-world experiences from different regions and pension models, from how insurers can ease pressure on state systems, to how savings can be channeled into productive investment, and how we can close persistent gaps in retirement outcomes. We will also touch on how to encourage people, especially younger generations, to start saving earlier and more consistently. So with that, I will introduce our panelists. So with me today, we have, not in any particular order, Felipe Navarro, Corporate Director of Investor Relations, Capital Markets and M&A at Mapfre, and Vice Chair of Insurance Europe's Life and Pensions Committee. We have Stephen Frank, President of the Global Federation of Insurance Associations, GFIA, and President and CEO of the Canadian Life and Health Insurance Association. Mario Nava, Director General for Employment, Social Affairs and Inclusion at the European Commission, and Professor Andreas Milidonis from the University of Cyprus, bringing an academic perspective on pension systems and reform. So I'm going to get right into it. First of all, let's talk about the challenge around pensions, what's changing, why it matters. Mario, I'm going to start with you. We often hear a lot about better retirement outcomes. From the EU perspective, what does that mean, and where do you see the biggest gaps emerging as populations age? And then I wonder if you can also talk a little bit about the member states and the gaps that you see there, where you see the biggest gaps.
Okay. Good afternoon, everybody, and thank you very much for the invitation. I mean, when you say better retirement outcomes, I think you need to understand better in a, let's say, dynamic way, because to be very fair, till now, the pension system in Europe has delivered. We don't have any particular proof that the pensioners are worse off than the workers. We don't have any particular proof that there is a bigger gap. There is some gender gap, exactly as in the worker, but till now it has delivered. The issue is what? The issue is the following. The issue is that now the demography is, of course, changing pretty dramatically, as we know. And when you talk about aging, you need to understand what it means. It means that people turn the retirement age, say 65, 67, and then they continue to live happily for 30 years. They work, but they are not workers anymore. Now, if you look at the numbers in Europe, and you compare the numbers of those who turn 65 and the numbers of those who turn 25, 20 years ago, there was 1 million difference in favor of the 25. Today, there is 1 million difference in favor of the 65. In 5 years, there is 1.5 million difference in favor of the 65. From now till 2050, we lose 30 million workers and we gain 30 million pensioners. So that's the issue. And so the issue is an issue for the next 25, 30 years. How do you come out of that? First of all, of course, Pillar 1 needs to remain solid, and that's obvious, and that's why the Commission insists a lot with member states. We talk about pension in the semester, we talk about pension when we discuss long-term sustainability, we talk about pension in the various regulation and so on and on. But it's also important to understand that if we want to maintain the same good level that we have achieved today, the Pillar 2 and the Pillar 3 matters. And here is where, of course, the recent, the November Commission publication impacts, because very simply, because of the demography, Pillar 2 and Pillar 3 will be more important in the future, which per se is not a bad news at all, as long as you know it in advance. It would be a bad news if you don't know it in advance, but if you know it in advance, and you can prepare to that, is not a bad news at all. So that's, I would say, you ask me what is better, I would say better is this, being able to understand what happens in the next 30 years. Then, the future is long, and after the 30 years it's very difficult. But at least in the next 30 years, it's very clear what happens, and that's why we have published the document on pension in November last year.
And in terms of the national gaps?
In terms of national gaps, pensions are very different one from the other countries for a number of reasons. One reason may be simply the history, how citizens have conformed to that. And it's very clear that pension reforms in one country are maybe much easier than in other countries. What is common across countries is the demography, and I would say what is common across country is the understanding that using Pillar 2 and Pillar 3 may help. And that's why in our documents, for example, we speak a lot about Pillar 2 at scale. Why? Because in some countries, you actually have the Pillar 2 you need. So for some countries, don't need to go further. But what you need is to put it at scale at the European level. Or Pillar 3. Pillar 3 for some countries is inexistent. For other countries, there is something. So there is of course, a diversified issues across countries.
If you're having thoughts or questions about any of this, don't forget to feed them through on Slido. We'll have a Q&A at the end. Andreas, I'm going to come to you next. So you're from Cyprus. It's in the middle of a very important pension reform. It's hoping to improve adequacy for low-income retirees, strengthen the long-term sustainability of the system. As an academic, what do you think about how the pensions challenge is evolving in Cyprus?
Thank you, Kathryn, and thank you for the invitation. It's really a privilege to be here in front of this crowd. So as you rightly said, in Cyprus, the synonym or let's say the nickname of pensions is state pension. That's where most people expect to get their pensions from. So now the pension reform in Cyprus is trying to make, let's say, changes that haven't been done for the last 40 years. So let me summarize. 2 problems we're trying to solve. Number 1, income replacement ratio in Cyprus is like 42%. European average is 58%. European target is 70%. So we are at the bottom end of the distribution. So at the moment, the government is trying to find a way to send some of the social security funds into an investment, into an external, let's say, investment fund so that they can generate some returns with that. That's going to be a big challenge. The second challenge we have is the issue of supervision, and I'm going to say trust as well. And what do I mean by that? I was actually speaking to Felipe before we walked on stage. Cyprus and Spain, according to EIOPA, are the only 2 countries in Europe that do not have an independent supervisor for pensions and insurance. So that is an issue that needs to be addressed. The government already made some announcements. We're waiting to see how they will materialize. So those are the 2 major things that need to be addressed. Now, let me go back to the retirement adequacy issue. Pillar 2 and Pillar 3 in Cyprus are small. And probably one of the reasons that this happens is because in Cyprus we have one of the highest income thresholds below which you do not pay any taxes, income taxes. So I think the threshold at the moment is around 22,000 euros. About 46% of the population in Cyprus falls below that threshold. So that means they have no tax incentives to participate in Pillar 2 and or Pillar 3. So there is a structural issue there in addition to the supervisory issue. So one suggestion we have made back in 2022, perhaps this also applies for other European countries that face a similar problem, and it's currently on the table being discussed, is the following. So to offer a quote-unquote required defined contribution plan for all employees in Cyprus with an automatic enrollment. They can opt to leave after they enroll. Where, because of the issue we have with the tax deductible contributions, where there is no tax incentive to contribute, the suggestion there is for the government to come in with a relatively high contribution at the beginning that will be decreasing over the next decades, I'm going to say 3 decades. At the same time, you can have employers starting very low and increasing over the next 30 years. And for the employee to receive both contributions, of course, we're going to have to match these contributions. So the incentive that is missing from them will be coming from this, let's say, subsidy over the next several years to get people in. So these are the challenges that we face in Cyprus. Financial literacy is another issue, but I think we need to set up supervision and then the tax incentives for participation in pensions before we even go to financial literacy.
Well, let's go from Cyprus to Canada. Stephen, I'm going to come to you. Like other countries, Canada's having this huge retirement wave. It's gradually moving away from the defined benefits approach towards more funded and contribution-based arrangements. So from your perspective, what do you think are the pros and cons of gradually shifting some of the risks to future pensioners? And what are the building blocks that we need to see for a resilient system?
Well, yeah, thank you, and great opportunity to be here. So Canada also has a 3-pillared system. So the question you're referring to is really our pillar 3. Pillar 1 and 2 are sort of more government-focused. They are typically pre-funded. We have some demographic pressure, but not to the extent that Mariel's described. But so those are on sort of solid ground. What we've seen in pillar 3, though, is we've essentially bifurcated our population. If you're employed in the public sector directly or sort of in an adjacent area like healthcare or the fire department, police force, et cetera, you continue to have a defined benefit program. But 85% of people in the public sector continue to have very generous defined benefit programs. They've effectively disappeared on the private sector. So about 20% of people in Canada continue to have a DB plan. Those are almost exclusively closed to new employees, and they're in roll-off. So you've got this interesting situation where you, in some ways, have this split, this cleave that's starting to happen. A couple things have started to, a couple things I would note as a result of that, sort of at a macro level, and a lot of discussion today and over the course of the many months about the sort of rising tensions in society and populations. Having that kind of cleave is not healthy. It creates a sense of others having things I don't have access to, and that's starting to materialize a little bit in some of the discussion. And it does also put a real barrier on labor mobility. It is hard to attract people out of the public sector, and that pension plan can be a bit of a barrier. And you know, I see it in my role fairly regularly. At a fairly young age, people are already self-selecting out of opportunities because they want to protect that benefit. So there's some macro sort of things that you want to try to avoid that we're starting to have to sort of grapple with, but I don't see there's any movement to go back on the private sector. So we have to live with what we've got. You said, what are the pros and cons? Well, it depends on where you sit. As an employer, there's some nice advantages to pushing that risk off onto the individual. You don't have to be responsible for that anymore. And the very significant administrative and reporting costs that come with managing a defined benefit plan, you get to offload this as well. And you know, we've closed our pension program at the CLHA. We've recently purchased a buyout annuity to move that risk fully off. I can tell you it's a material reduction in my sort of stress every quarter having to not do those reportings and filings. So those are real. If you want to protect those DB plans, it's something policymakers need to think about. How do we lessen the burden for maintaining those programs? What are the cons? Well, as an individual, it's all on you now. And I would say 95% of people are incapable of making over a lifetime smart choices on their own to save early, to do it in an efficient way, and sustain that. And so as that transition happens, I think, Mary, you mentioned it, if the population understands it's happened, they have to understand that's happening. It can't be a surprise 20 years down the road, so we have to be transparent about it. We have to educate them on what it means. And then I think industry needs to do a better job. We need to find ways to sell into the middle market. It's an area that's underserved. Insurers, wealth managers all want that upper end market. How do we get into that middle tier where the vast majority of people are with product that's affordable, meets their needs, and accessible to them? So, a lot of time is being spent in Canada and throughout North America trying to think of what's a distribution approach that can work. What are products that will work, and how do we get people to make those positive choices to invest earlier? So we're in that transition, and it's having some big impacts on us across the society.
I'm hearing a big financial literacy theme so far from all of you. But Felipe, I'm going to come to you now. So Mapfre, you're present in several countries. You're in Europe and Latin America. Very different pension systems, different levels of market maturity. What do you think are the common challenges emerging in all of the different territories that you operate in? And are there lessons that non-European markets, that Europe should be paying attention to from the non-European markets?
Thank you very much. Thank you very much for having me here. In fact, the problems that we can see in different countries are not so different. I mean, we can find different demographic shapes on different countries, but at the end of the day, the trends are exactly the same ones. There's a reduced number of fertility. The numbers of children by person is reducing. Second is that the longevity is increasing everywhere. So at the end of the day, we have exactly the same problems. The different regulations on the different countries can be as different than the one that we have in Chile or the ones that we can have in Nicaragua or any other Central European market. But at the end of the day, we are facing exactly the same kind of problems. The second part of the major problems that they have are related with the nature of work, which is similar to the one that we have here. We have more and more people that have non-linear careers with different employers, with periods of time where they're self-employed or employed by a third party, and where the labor, their careers are interrupted for a certain period of time, and even in these markets we find that kind of labor informality that we can find in those countries that are more often than Europe. So this is an addition that we can find there. What kind of challenges and what kind of design we need to have for solving these kind of problems? The problems of a traditional system that is facing people that are one employer or two employers in their lifetime that have a stable income and a stable situation is not anymore the solution with one single system. What we want to see is that the adequacy of the systems that we are planning right now and coming from the public initiative are not enough. We need to have a multi-pillar structure that are based on the Pillar 1, Pillar 2, and Pillar 3, combined both of them together and providing with better solutions. We need to provide solutions for portability, which is key, with rules that where you can get into the system and getting out of the system, with auto-enrollment that will be mandatory for all the companies in order for the workers to get, whenever they are employed by a third party, or whenever they can go into one system, that they will be contributing for this for their retirement, and that in the moments that their careers are fragmented, that they could access to this. So we need to have a combination of these contribution or contributory systems with non-contributory. So that is key. Future challenges at the end of the day are the same ones that we find in Europe and in Latin countries. Probably their big problem is going to take couple of decades more than in Europe, but they're going to face the same kind of problem. And we need to find a solution that will provide sustainability, inclusion, including 100% of the population, not only the regular employed one, and flexibility in order to take out or in from the system when it's needed.
Thank you so much. Let's talk about policy now. Who better to talk about policy with? The European Commission. Mari, I think there's a bit of a contradiction when it comes to pensions in terms of the Commission is so passionate about this and it's doing so much. We've seen the PEPs and the IOPS reviews under the SIU strategy. And at the same time, pensions are predominantly a national competence, so there are limitations there to what you can do. What's your ideal scenario moving forward in terms of that? And where can you see the insurance sector adding more value to support national pension systems?
First of all, that's not a contradiction. That's what happens in life, and that's what we face in many areas. I mean, and as my president said, if it is a problem of the Europeans, it's a problem of Europe. So we are the last to hide behind any, let's say, sophisticated discussion on competence. In the supplementary pension package, we put forward two things. One is the new IORP, so the amending directive on institutional occupational retirement pension. And I know in the room somewhere there is Karel van Hulle, who was the father of that a few years ago. And then the other, which is probably links very well to this room and to what both Felipe and Stephen said, is the new PEP, the amending regulation on the pan-European personal pension products. Why it links well? Because I think Felipe made an extremely important point for us, which is the demand point. Life is more uncertainties, careers are not linear, people will change job. To give you statistics, people of our generations, we have changed 1 or 2 jobs during our lifetime. It's now estimated that people will change 7 or 8 jobs during their lifetime, with the little detail that our lifetime was about 30, 35 years. There is 45, maybe 50. So clearly there is much more uncertainty. There may be period off, there may things. So the demand side, in order to have some individual pension or let's say insurance product is huge, is undisputable. On the supply side, and here what Stephen said is very correct, and I said with due respect to all of you here, I think the industry should do much more. I mean, you have a highway in front of you. I normally do the final talk with the stagiaire. The stagiaire come to us, you know, they are an happy bunch, lucky them, they are 23, 24, and I always ask them, what do you do next? And they always do the same thing in the same country. What they do is, I don't know, I don't know. This means what? This means they are mobile. This means they are mobile both geographically and vertically across sectors. And the only thing they need is to have a good insurance package with them, which should facilitate their mobility. Of course, if you say to a 25 years old girl or boy that here is a good package, just it costs 100 basis points a year, he looks at you in disbelief. He says, what are you talking about? 100 basis points a year to do what? To give me the beta of the market? I'm not stupid. I go on X platform, I buy an ETF and ciao. So I think this is the point. I mean, if you ask 100 basis points a year, you should give me alpha, which is very significant. If you want to give me the beta of the market, which is 95% of what people need, then it cannot be 100 basis points. And I think this is the whole issue. And to me, if I can use an expression, I think till now, the PEP products, not the PEP, but let's say Pillar 3 pension for young people, it's a product pour les gosses des riches, for the kids of the rich people. That's what it is. The moment the industry is able to transform that is a product, a mass product, something that every person normally at 25, he does a stage either in the Commission or at Insurance Europe or at whatever company of yours, and then he says, you know what, I now start saving 50 euros a month into these things because I know I will need these things for the next, lucky them, 70 years. That's it. But of course, it needs to become a mass product. and not anymore a rich product or a niche product. So I think that's the issue.
Any industry rebuttals there? No?
We tend to agree. I mean, this is something that we need to face, and this is something that we need to add value on and providing more alpha. And I think that I will delve into it a little bit later on certain ideas that we have as an industry.
Okay, Stephen, let's talk about long-term savings products. Insurers are obviously long-term investors. The long-term products are important. From the Canadian side, do you think that the sector has the right tools to kind of underpin this long-term saving at scale? And what can the insurance sector do to help individuals there?
Yeah, so I do think we're in a fairly good place on that long-term question. North America is different than Europe. We have a culture and an understanding in the population that we are responsible. That Pillar 3 is fairly large, and so people are actively understanding that. So the ability to sell longer product is there. It's not growing. It's in fact shrinking a little bit. So we do have a problem that we need to address, but there's a nice sort of foundation there. And there's a good regulatory wrapper around all of that that's there to support it. And one of the reasons that Canada has opted out of the ICS, for example, is concerns around capital and sort of the headwinds that some approaches could have on those longer products. So we've got, I think, a good ecosystem to build from, but we're nowhere near where we need to be. And I'm not going to defend the industry. I think Mario is bang on. We need to be doing a lot better. I think trying to solve this problem through the individual retail channel is going to be exceptionally difficult. It's just so hard to find a distribution model that works. It's so hard to price those products and to offer it to people and to get them to buy. To make that positive choice is very, very challenging. So a lot of our focus in Canada is more through the group environment, through an employer. You get the scale relatively quickly, and if you can work that a bit better, I think we see opportunities there. So about 90% of those long-term savings products would be through an employer relationship. 10, 15 in Canada would be something we're selling on our retail. So I think there's a sense that that's probably the way you need to go. It doesn't help those in very small business or self-employed, and so that's where some of that gap comes. The only other idea I'll throw out there for the audience, because we're spending a lot more time thinking about this right now in Canada, is what happens when people turn 65 and they retire. And I always joke that we spend 30 years wrapping people in a nice warm blanket, and we give them lunch and learns, and there's advisors talking to them, and there's promotional material on TV, and we educate them, and we help them accumulate these great assets. And then they turn 65, and we sort of shake their hand and say, over to you. You're on your own. And we see in Canada that people are, again, the average person cannot intelligently manage their longevity risk, their mortality risk. They don't know how to decumulate in an intelligent way. And the statistics are quite stark. If you're on a defined contribution program, you're holding back money that you should be spending just because you just don't know how much you need. And we estimate the typical individual spending about 20% less than they could if they're on a more predictable income stream. And so that's just huge for us. And there's that large cohort that's hitting retirement. They need help to retire well. And insurance is so well positioned to provide solutions there. There's pooling techniques, there's variable annuities, there's all kinds of things we can offer that could be so helpful. And so we're trying to talk to government and try and find solutions for sort of both ends, that accumulation piece. But we're increasingly aware that maybe people need a bit of help in retirement to be doing it to the maximum of their abilities. So industry needs to do better in all those areas. We need to work with governments and regulators to help unlock some of that pooling, to do that intelligently. So there's lots of work happening across the board on both of those.
Do you see that as being, this idea of sort of the lifelong financial literacy, is this a Canadian issue? Do you see this across the board?
Well, I think we'll get into that later. I'm a bit skeptical that financial literacy is the solution here. I think people can understand they have a problem. That doesn't mean they're going to go home and log into the portal and actually do anything about it. So getting people to action is a completely different exercise. And I think I heard, Felipe talking about auto enrollment and those kind of nudges, those kind of intelligent uses of what behavioral economics has taught us people need, we've seen around the world can have enormous impacts. And so we're more probably focused on those. Financial literacy is important, but I'm skeptical it's actually going to move the dial. Even the most well-intentioned people are not going to their doctor every year, and we all know we should, right? So.
Okay, then Felipe, I'll throw it over to you. What do you think are the regulatory market conditions that are going to help insurers do more in terms of adequacy for retirement? I mean, where's the sort of distinctive offer here?
I think that's key, because I think that the insurance industry provides with a little bit more than other industries for the pensions, for the pension systems. Right now, there's a big fight on the accumulation period between banks, insurance companies, mutual funds, and hedge funds, and they're looking for how they are going to manage the wealth of the people until they go into retirement. The thing is that the insurance industry it can provide a lot more solutions for these kind of gaps. For the moments then when the person is out of employment, when the person is with a break or changing for self-employment for a third-party employment. So we can manage the long-term risks, investments, longevity, inflation, mortality, disability, and certain part of the uncertainty of the income during their life, and that because of the pooling techniques that pure insurance companies can provide, and we are the only ones in the market that we can do with this. The solutions need to be savings plus insurance, and when I'm speaking about insurance, could be pure life protection, pure covering risks of disabilities or similar, so that we can go with a person during their life. Retirement is not a simple moment in their life, as you said. The moment when you need to make your more difficult decisions is a moment where you are quite vulnerable. You don't have the support of your company. You don't have the support of the labor market. You don't have the support of a group of people that are surrounding you at a certain moment, and you need to take the most difficult decisions that are going to condition the rest of your life. And when you are going to be more vulnerable because you are going to receive let's say a big amount of money, because it will be something that you are being taking care for a long period of time, and there will be no proper assessment from the person. If they are not an insurance company, they cannot provide you with the right solution, with annuities, with other insurance solutions. At the end of the day, what we are providing with our distribution channels, with our agents that are present in their life, is something that where we can assess, and we are specialists when we are looking to assess this kind of solution. On top of this, I think that the insurance industry is the one that is providing with the best set of tools in order to have an asset liability management from the investment perspective. Something that we lack in other kinds of industries, and that it is true. It is probably the 100 basis points that we are looking at a differentiation between what you can have in an investment fund or what you can have with a pension plan with other features are not going to be perceived with an alpha that could be a differentiation for the person that he is 23 years old and they're feeling like Superman. Because people, when they're young, they're not caring about the future. So to wrap everything up, I think that without first having the three pillars working together and in the right direction, without auto-enrollment, without tax incentives that are key for the long-term investment, without a regulatory support for how we are going to behave, not only in the period of accumulation where there's a lot of competition, but where the moment that the person is going to go for these crucial decisions is going to be futile, and we need to be very much at that moment with those people, and I think that there we can contribute very much.
Do you have thoughts on that, Mario?
No, I agree very much with what was said now. I think in the moment we talk of the three pillars, it's important to understand that what this implies. If we say in the future people will have their pension income coming from the three pillars, it implies that saving is not anymore optional. That's what it implies. It implies that saving must be part of the equation of how you spend your money. Now this may sound harsh because you may say, well, but come on, there are people who have difficulty to make their ends meet, and how can you say that in addition to that they also have to save? And that's where auto-enrollment that Felipe mentioned comes to the rescue, because auto-enrollment somehow makes sure that you have an immediate saving. There have been some experiments in some countries where auto-enrollment was not done, and it created a major problem in few years down the road. This is, I think, is now part of the practice. Auto-enrollment is a very good practice in the moment you have additional pension. But overall, I would say what is very important for us to understand is that while in the past we may have been used to reason of I consume and then what is left I'll save it, sort of marginal for saving, this cannot work anymore in the moment you have the three pillars. It must be that the saving decisions are taken at the same level with the consumption decision.
Andreas, let's talk about developing complementary pensions. I mean, from your side of things, what do you think are the most effective ways to develop this? Is it something that should come through EU regulation, something like the PEPs and the IOPS that we've talked about? Are there other levers that might be more effective?
I'm going to take a different perspective from what my colleagues here said. And I think, let me start by commenting on what my co-panelists have said. Of course, PEP is going to give us mobility. Of course, IORP is going to give us a stronger governance framework. I will go one step down now to the tax incentives. So we all agree on auto-enrollment, and that's one of the, that was based on Richard Taylor's, the Nobel Prize winner in economics a few years ago, that works, and we all agree with that. Now, let's move a level below. Let's go to tax incentives. And let me share a personal experience I had about 3 weeks ago in Cyprus. I was in an informal, let's say, gathering of tax attachés from all member unions in Cyprus. There were 25 representatives in Cyprus, and I basically spoke about financial literacy, savings and investment union, and tax incentives. So I was going to speak for something like 70 minutes. I said I cannot be speaking for too long. So I thought I should be asking a question so that people can answer it in the room to also learn something from the audience. So let me read the 2 questions I asked the tax representatives, okay? First one was, in your country, which asset class is most tax favored? So the options were, cash, real estate, bonds, equity, and so on. And second question, is that intentional? So I was expecting a one-word answer for the first question and one-word answer for the second question. There were 25 people in the table. It took me about 30 minutes to go through half of them, and I was shocked. Like the level of complexity in the answers in this very simple question shows us that, and actually I didn't even hear half the people, so I had to stop it and continue with what I had to say. So the level of complexity we have on the tax incentives is shocking. So even if you build, good regulation, even if you build a PEP system, even if you do the IORPS, if people do not see a reason why they should be saving, then it's very hard for them to do that. Auto-enrollment will help, I agree. However, let me put another point on the table here. Financial literacy. I'm not saying financial literacy solves all problems, but I do not think you can do any of these things without financial literacy. And let me explain what I mean. So going back to the work of Richard Taylor, but also the work of Kahneman and Tversky, two academics in psychology who won a Nobel Prize in economics several years ago for their work on prospect theory. So what is financial literacy? How is financial literacy helping people, or let's say catalyzing these decisions to make a decision or not make a decision? Or if they are auto-enrolled and they feel that, maybe they don't have an independent regulator, then they opt out, and then you have nothing. So what are the issues that financial literacy can help solving? Procrastination. When we do not have any motivation to do anything.
Relatable.
Mario said before, save before you consume. That's Warren Buffett. He said that many years ago. Save and then knock yourself out. Burn your money if you want. Doesn't matter. As long as you have some savings, you have saved some money at the beginning. Financial literacy is going to help you understand why saving is important. Otherwise, if just there is an ad or a campaign that says save before you consume, nobody cares. Second issue. So after another issue related, another behavioral bias related to procrastination is inertia, where you do have the motivation, you know that it's good for you, but still you say, you know what, I'll do it tomorrow, or I'll do it next week, or next month, or next year. Financial literacy is going to teach you that you cannot beat the market. The only benefit you have, the only power you have as a 25-year-old is time. And if you get that from high school, or if you get that at age 20, then you can appreciate it and reduce the impact that inertia has. And going to Kahneman and Tversky, loss aversion. If people understand that when they win money, they behave in a risk-averse manner, and when they lose money, they enter the risk-loving mode, and they gamble with their remaining investments, that's a self-reflection of how most of us function. And I personally believe this is extremely useful to have at a young age. And I say this as somebody who, I'm also a member of the Cyprus Financial Literacy and Education Committee, where we have, with the Central Bank of Cyprus, we have conducted a study back in 2021 and identified the vulnerable groups with respect to financial literacy, basically being number one, young people, women, low income and low education people, and that's it. So you really want to give these people a boost before you can start talking to them about any financial product. Last point. I'm not saying that you have to be a financial literacy expert to use a Pillar 3 or a Pillar 2 product. We need simplicity. We need products that can go here, can be chosen by people in a simple manner without the fine print, and enough information for people to see and transparency. So simplicity and transparency at the lowest level, because that's where the decision is being made.
We're racing through our time slot, so I'm actually just going to chop down my planned questions for you into the same question for each of you before we take some audience questions, which is, what do you think would be the most effective lever in terms of improving retirement outcomes, and why? Whoever wants to go first.
Well, why don't we go down the table? We'll start with me, and then we can go. I mean, I think the auto enrollment, the simplicity is the way to go. I think that you have to help people make those decisions, and you have to help them young. And I think that education is a foundational piece, but people can know what they need to do. That doesn't mean they go do it. And I worry a lot about the mid-market and below. I think the upper market is ultimately fine in all scenarios. You've got a bricklayer or a plumber, and they're trying to save $500 a month, and they've got $1,000 at the end of the year. Who's talking to that person? Who's giving them advice? They're unhelped at the moment, and that's where the need is. We've got to do better as an industry at finding how do we get to those people. And I think the upper mid-market will ultimately be okay, but those folks They need the nudges, they need the help, they need us to steer them in the right direction. And so if we can get comfortable with that, and I agree completely with Mario, if we can get comfortable with that, I think that's a massive step change for what you're going to see at a societal level, and that's where I would encourage us to focus out of the gate.
I'll take it from there because I completely agree that the upper side it's fine. The middle and the lower part, nudging completely, Richard Taylor, that was said. It's important that nudging comes with information. So one experiment we are doing here in Europe is the so-called pension tracking system. There are 7 or 8 countries where if you want in this moment to know what is your Pillar 1, you go here and you know it. And that is crucial to know how much you want to invest in Pillar 2 and Pillar 3. Because if you don't know what is Pillar 1, then we go back to what Steven said before. In defined contribution, people spend much less than that. So I think information could really help the lower and the middle. And the very third thing, I liked a lot what you said about the young people feel Superman. And that's exactly where the incentive needs to go. There are some countries who give incentive for saving. You save today, and here the good news, when you will be 67 and get your pension, that will be taxed. Talk to a 25-year-old person with that. If you say, okay, you invest today, and then maybe you get some sort of co-participation if it is very low, or tax reduction is probably different. I think we need to have a little bit more of psychology and behavioral insight if we want to move the people there.
I tend to agree with both of you. One thing that surprised me is that this is not a simple problem. I mean, this is probably the most complex problem that we are going to face, all of us, when we turn the age of retirement. And try to find simple solutions to complex problems is, I mean, we could fail into the populism, or you call it, you can call it in the different ways. So let's find out how can we help people. I think that first pillar is key, to have a minimum income in order to have the basic needs covered, and the second and third pillar need to be assessed by a professional. So there you need to have the right assessment, the right people that have been already trained. It is true that the financial literacy is key, but the person that is in front of you, selling you the right kind of product for your right kind of problem is key as well. And I think that in this case, insurance industry is very well prepared. We're very well equipped with people that are knowledgeable of the products that we can provide them, and knowledgeable of how can we find solutions, because I mean this is what we do in a daily basis in a lot of insurance companies.
Andreas.
Very quick. I think trust is number one. Trust is something that countries that have a trust deficit have to work on by making their institutions stronger, and that relates to the independence of supervision of Pillar 2 and 3 that I mentioned before. Simplicity, features like auto-enrollment as well, and information, tractability so that people can see how their money grows. And I will insist on financial literacy, and specifically, since we are talking about insurance, risk literacy, a subset of financial literacy that is actually receiving the lowest scores. People do not understand risk. They can speak at a cafe about the price of this stock that went from 50 to 60, but when you ask, so what's the risk? Well, nobody can describe risk over a coffee. So I think it's important to focus on the younger generation, and also digital literacy as well.
Great. We've got some questions coming in on Slido already. We'll just take a couple. Okay. Are current debates on retirement outcomes too focused on saving more and not enough on ensuring that people save into products or through systems that actually deliver value over time? Who wants to take that one?
I have a view on that, but if others want to start, please,
Go ahead.
Yeah, I think we need to simplify this, and I think we've run into the trap of, and Mario, not to pick on your first, but the alpha and the beta, and we try to optimize. I think we just need to get people saving, and so for me personally, I think the first order of business is getting people saving, getting them committed to a plan, and they start to accumulate. Once that happens, you can start to optimize. But if you don't get that right, and if you make it too complex and you make it too difficult, they don't even start. And so we see clearly in Canada in particular, if you have an advisor and you have a plan, you retire with more money than if you don't. It's irrespective of what product, what fees you paid, where you were placed, it's the plan that gets you going, then you can optimize. So on that one, I would say, no, we should focus on getting people saving, and then we can worry about how, when, and how once we've got that machine working.
I do totally agree. I will insist on the key tax issue. If for a youngster you don't give them something that they can have an immediate satisfaction, which is Instagram, but in this case, the saving of some money because of taxes, it's worthless. I mean, you can tell them how many risks they're going to face in their life, how many problems they're going to happen, how many issues we can share with them as experience, but they will never find that this is going to be on their roadmap.
So I love Instagram. What are you trying to say about me? I'm going to take another one very quickly before we close. How can insurers strike the right balance between security of retirement income and putting savings to work for the economy?
That's a good one.
I didn't hear it.
How can insurers strike the right balance between security of retirement income and putting savings to work for the economy? It seems like an SIU question.
It's easy.
That's a good one. I will take 1 minute, no more. When you look at the balance sheet of an insurance company, everybody is caring about how we invest, how we manage the money. So this is how they can put their hands in our resources in order to provide them with long-term investments, with financing for good projects, for big projects, for long-term projects. But they are not taking. I mean, they're not looking at how much we are committed with insurers and with our policyholders. So this is something that I will very much take care of and say to the regulators and to the politicians that be careful. I mean, we are playing with the future of a lot of people when you are trying to divest or direct some investments for insurance companies for those kind of investments. And we are a very powerful investor, sorry.
I would just add, we are natural long-term investors. So the concern was, how do we invest in the economy? When you're in an insurance world, that is a follow-on, but don't tell us where to do it. But we are natural long investors. We hold things for 50 years. Yes. So we're the only stakeholder that really takes that on.
Just one comment also on the previous question. I think one challenge we have here is assuming we have achieved to convince people to save more. And then the next step is ask them to invest. How do you convince them to invest in Europe? So that's challenge number one. We have to think not only about investments, but also investments in Europe, which is a major challenge. I see that funds, for example, leaving Cyprus are entering global funds and especially US funds. So the competitiveness of European investments. And number two, tax incentives, again, need to be tied with a long-term horizon of investment. So that's something that can bring potentially both together.
Mario, I give you the last word.
I think investing in the economy and preserving the money is not in contradiction, especially in the long run. So.
Okay. Well, thank you so much to all of our panelists. We've completely exhausted our time slot, and I don't want to stand between these people and their coffee. So just to let you know, coffee will be back in the place where you're expecting it, and we'll be back here at 3:15. Let's have a massive hand for all our panelists.